Good day, and thank you for joining us for New Harbor Financial's live question and answer. Today's Thursday, February 12th, 2026. Regina, thank you for setting this up. Today we have live John Blodra, Jay Mayer, and myself, Justin Griffin. Mike Preston, one of our founding partners, is on vacation today. We'll let him take the day off. And Michelle Moss is also not available today, but will be on our next live Q&A. We'll give a second for people to join and get in. There is a live comment section within your viewing area, so please feel free to ask questions. We'll do our best to answer those either verbally here, or maybe Jay or John will jump in and answer some questions as well.
Hello, everybody. Welcome. Thanks for joining us.
All right, let's get going with our first question. I think it's a timely one. I think there's some press releases going out right now about this one. Per Bloomberg story this morning, Russia and Trump are making a deal including fossil fuels and offshore drilling. But the big point is Russia would return to the US dollar's settlement system. This seems to have big implications for gold. And what about the de-dollarization threatened by this? John, your thoughts on that?
Yeah, so there are some headlines out about something of this nature today. I think it was a Bloomberg report. And as best I can tell, it's been a busy day for us here, like many days. Had lots of client calls, not specifically on that. So have some reading to do tonight to catch up on what exactly is the news and whether it's as significant as it appears to be. Anyways, it sounds like there was an internal memo somewhere in the Russian political system that gave a sense that there was going to be some collaboration of sorts between the U.S. and Russia on some big picture stuff, oil and gas development, natural resources, trade, and a return by Russia to the U.S. dollar system. Even that one last soundbite is there's a lot of nuance there. What does it even mean to return to the U.S. dollar system? So I caution folks to, certainly the market has responded today, and we think probably in relation to this news, a lot of things that have been strong have sold off, and a lot of things that have been weak have rallied. So, probably a typical news headline, perhaps buy the rumor, sell the news type of thing. Frankly, we just need to see what kind of level of truth and substance there is to this. But broadly speaking, this goes back, I forget even what year Russia was sanctioned, and it brings back a bigger picture theme of the the world becoming smaller from a trade and collaboration standpoint. Much of the themes that we have seen over the last couple of years has been, kind of reshoring, instead of global coordination on things like trade and currencies. There's been for many years, there's been talk about emerging markets and Russia and China looking to de-link from the US dollar as the world's reserve currency. And there are very good reasons for that. So, for example, not to sanction or endorse any things Russia did many years ago, but, we basically went out and basically sanctioned Russia by freezing a whole bunch of assets, including, for example, there were investment products that US investors could have invested to have access to the Russian stock market that essentially overnight went to zero. They were essentially sanctioned. So this is many, many years of tension that I frankly find it highly unlikely would be solved, in an instant in an internal memo or headline. But bottom line is we're gonna have to wait to see. But the market seems to be responding pretty quickly. If there are progresses along these lines, it would seem to have some moderating effect to worries about, kind of the U.S. dollar being under attack and things like that. But it's just way too big and multifaceted an issue to kind of pin a soundbite news headline and think we're going to suddenly know how everything works out. But something certainly to be watched and learned more about. So thank you for that very timely question.
Thanks, John. Jay, I'd like you to kick this one off here. Could you please review the disadvantages of using mutual funds versus ETFs in my portfolio, or direct investments in stocks, bonds, etc.?
Yeah, happy to chat about that a little bit. This is something our clients always ask about since we're primarily invested in ETFs, right? There's a lot of good benefits to ETFs that make us prefer them. They're obviously very liquid. They represent baskets of securities. So for some more kind of niche areas of the market, we have emerging markets, local currency bonds, for example. It makes it more accessible for investors. Optionality, right? It makes it very easy to hedge risk in a specific sector or position. If you have 30 shares of Lilly, right, that could be a material portion of someone's portfolio. You can not perfectly hedge that, but if you use XLV, for example, or something, you can hedge that more easily with options, just from a dollar standpoint and marrying the hedge to the dollar amount. So there's those reasons. Of course, it offers diversification as well from a business risk standpoint. If you think about buying Microsoft outright, they have a bad earnings release. You could be out 10% overnight. That'll be a little bit more neutralized with a tech ETF. So all those are reasons why we like ETFs, specifically addressing the mutual funds. It's our opinion that ETFs really beat the pants off of mutual funds wholeheartedly. And that's because there's tax inefficiency involved with mutual funds. You don't have real-time liquidity. There's no optionality, tons of layers of fees, right? ETFs, that everybody asks about the expense ratio, but mutual funds, you can even take a ticket charge entering or exiting at any given time. And in a market downturn where there's real volatility, having a mutual fund, you're not going to be able to know exactly what you're in for in terms of the damage until the day closes, right? At least with ETFs, you know exactly where the basket of securities is trading at any given time. And that's what I mentioned with the real-time liquidity. So a couple thoughts there. Definitely, especially in regards to mutual funds, ETFs are a little bit more superior on those. So those are my thoughts, or our thoughts rather.
John, do you want to maybe add any context or color, where we would ever use a mutual fund specifically in our model, or maybe access to certain markets as such?
Right. Yeah. And those are for those really esoteric and specific situations. A lot of times you can have mutual funds that are really well active managed. We are fans of the John Hussman's fund. We've used that in the past, and that's a really esoteric, actively managed mutual fund that is a strategy that would be kind of hard to find in an ETF wrapper. But those are really the reasons that we would use a mutual fund. It's a really specific, strategy-specific kind of approach, while ETFs are better for kind of basket strategies. So that's why I would say that.
I'll just add one thing here. So to the contrary, I think many folks have a perception that ETFs can be risky or not a safe way to invest. I think there's a lot of misconception out there. The ETF structure is a very efficient, very sound structure. Where I think there's some confusion is there are some ETFs that hold very illiquid underlying securities. It's not a problem with the ETF structure itself, but it's in the securities that they own. They can be very esoteric or illiquid securities. So it's not a function of the ETF structure. It's a function of those illiquidity of those securities that create the problem of inability to trade efficiently or effectively, or without the market moving very quickly on you. But the ETF structure itself is a very sound structure, and it's because the way they're created and redeemed, they literally can go out and purchase the underlying securities to create or redeem the actual ETF units. The financial industry is no stranger to innovating products under the guise of innovation. I think the ETF innovation is actually a really value-added thing that very few things have reached that scale in the last couple of decades, certainly since we've been in this industry.
And before we get too far off this topic, Steve asked about if NH is against individual equities. Categorically, we are not against individual equities. It's just not how we're managing our portfolio in this environment, given that business risk, given where valuations are at. Obviously, we have clients that have great ideas and great specific stock picks. We encourage them to chase those. Just when it comes to managing our broader portfolio, we like the efficiency and the liquidity and the flexibility of the ETFs for the reasons we mentioned before. So.
Yeah, one thing to add that too is we'd expect to have a core position in individual stocks if we had a pretty material pullback where we saw durable gains likely for a while, so we haven't seen that in a while, and that's why I don't think we haven't had individual stocks in a while. Next question for you, John, to kick off, kind of talking about options and hedging. I'll read the question. I'm wondering if the market pullback on precious metals a week or so ago might lend itself to you providing a real life example of how your put call option strategy helped hedge risk in that situation. Why don't you kind of share that with us, John? Obviously, we're seeing a bit of that today again, too, and maybe share some screens if you wish.
Absolutely. Great question. Thank you. So yeah, we can use options to hedge risk. And I just a little bit of a reminder, there's a certain account size scale that we need to have to be able to use options, simply because option instruments trade on related to 100 shares of the associated underlying security. So for the position sizing we're looking for, sometimes smaller accounts don't have enough shares to actually be able to overlay options. It's not necessarily a good or bad thing. It's just the reality. Point being is we think our tactical approach can still deliver very good risk-adjusted returns, even if we can't use the option tools. But for larger accounts where we do have that capability, we think it's an added level of value that we hopefully can add in terms of mitigating risk, managing volatility, and all that kind of stuff. So let's get right to the precious metals action. I'm going to share a screen here. Hopefully this works okay. And there we go. Present. Share screen. And I'm going to go to window. Okay. So this is a chart. This is a weekly chart of an ETF, GDX, that holds a basket of gold mining stocks. Now, we know we have many clients on this video here today. There are other folks who aren't clients. So I want to just remind folks, anything we say here isn't meant to be personalized financial advice. Certainly, we're happy to talk to any of our clients or any folks who are listening just because they found us. Feel free to reach out to the team here anytime. We'd be happy to bring this right back to your particular situation. So this is, again, an ETF GDX. This is a weekly chart going back to 2023. Okay. You can see very large, and right here is the turn of 24 to 25. You can see 2025 was a massive up year for GDX, the gold miners. There was a bit of a pause back in October of last year, and then we started this year off very strong. And then on Friday, I think it was January 30th, I might have my dates wrong a little bit there, but it was the last Friday of the month, precious metals, gold and silver and related mining shares sold off very hard. One of the biggest down days in that single down days in the bullion prices in history. Now, ironically, even with that down day, silver, for example, was down almost 30% on the close. It was still up pretty considerably on the year, even with that down day. But what this shows is on this chart, we have you'll see a couple. First of all, each one of these bars is a weekly move. Okay, so that was a pretty big weekly move. You'll notice I have some dotted dashed lines here. Those are on the accounts that are large enough to have option hedges. We have half of our gold mining position hedged with what's called a collar. A collar is simply the combination of selling a call option, and in this case, we sold a call option with a strike price of $120 a share, and bought a put option with a strike price of $92 a share. That's what these dotted lines are. They're meant to show the legs of the collar. Now, we took in more premium by selling this call option than it cost to buy this put option. Now, what you see here is that GDX on that big sell-off pulled back right to where our hedge was, our put option hedge. Had that continued to go down further, this line in the sand would have been exactly that. Our clients, for the half of the position that we have hedged with that, would have been, very much insulated from further declines. Okay. Now it's bounced a bit since then, but the point being is we have very robust protection in place. If we look at silver using SLV and ETF as a proxy, I'm going to go to a daily chart here. This is a daily chart. You can see the magnitude of the move here. We had a very parabolic move higher in silver and a very big pullback. All through much of this increase here, we had some hedges in place that candidly we were getting quite concerned about how far and how quickly silver especially rose. In fact, because of the hedges that we had deep in the money call option hedges, that a good bit of this blow off move here, short-term blow off move, our clients didn't really participate much in because we were more concerned about the sharp pullback. And that's exactly what happened. We couldn't say exactly when it was going to happen. But there was, in our opinion, an increased probability of that happening. And sure enough, that did happen. And on that day where silver was down almost 30%, that was almost a non-event for our clients in that position that we had silver with the hedges on it. But what it allowed us to do is not only have our clients, take that down move without much of a blip, we were able to reset our hedges. So right now we have call options with a strike price of 75. So I looked earlier today, even with today's 10% or so pullback, more than half of that pullback is being offset by those silver call options. Okay, so just want to remind folks that hedging and options are not meant to be a profit center unto themselves, but a hedging tool against some of the underlying. So when in a day where the options are up in value, it almost certainly means the thing that they're hedging is down, and vice versa. And that's really what the whole purpose of the hedging is meant to be. So hopefully that gives you a vivid example of not only the recent episode, but more generally how we can use hedging tools. And we can use it on virtually any of the investments that we hold, whether it's long-term treasury bonds, we can use it on the stock holdings that we have through various ETFs, but very, very vivid example in the recent volatility of precious metals.
Thank you, John. Next question to you as well. In your opinion, what caused the rise and then fall and instability recently with the gold and silver prices? And what are our thoughts and expectations of metals going forward?
Yeah, so quite frankly, the near-term volatility we think was just a function of the metals moving too far too quick. We like to use the analogy of a rubber band stretching around kind of a resting spot, and that rubber band frankly just got stretched really quick. If you were to look at the week before the precious metals pulling off as hard as they did, both silver and gold were in the 99th percentile of degree of extension beyond kind of what we call a 50-day moving average. And it's not a guarantee or an absolute crystal ball that the price is going to do one thing or the other, but it just increases the probability. It's like, if you got really dark storm clouds overhead, you're going to have a much higher probability of predicting rain than if it's a blue sky, right? And that's all that, we think happened. Things got very much overstretched. I think maybe as soon as tomorrow, Regina is going to publish a video that I did a week or two ago, asking it's a fair question with the size of the pullback in precious metals. Again, I think it was January 30th, and there's been volatility since then. It's fair for folks to wonder: are we at closer to the end of the run in precious metals, or somewhere in the beginning, or mid stride? And a lot of people that were invested in precious metals going back to like 2011 saw a major peak in silver and gold, only to be sold off very strongly in the weeks and months that followed. And much of the 2010s, right up to about 2019, precious metals were essentially dead in the water. They basically went nowhere. So it's fair to ask: was that evidence that we were going to see another episode of like the 2011? And the simple answer to that, I believe, is no. And the video gets into this. And one of the big reasons, and Ray Dalio, who's a famed investor, founder of Bridgewater, the world's largest hedge fund, has been very much on the airwaves talking about the role of precious metals, not as an investment, but as a form of currency. That's the way we view it. I would caution folks to not think about precious metals or mining stocks like they would the S&P 500. What it is, it's a sound currency, hard currency, if you will. And they tend to do well or are a good hedge against the very things that we have seen. We've seen money printing. We've seen massive expansion of indebtedness by governments, especially, and not just here in the U.S., but the world over. So there's a good reason why the world's central banks, for example, have been accumulating gold in increasing amounts and have communicated an intention to continue to do so in the next bunch of years. Understand that QE and the money printing that happened in the wake of the housing crisis hadn't even been done yet when the 2011 peak in precious metals was observed. So we've got a much different fundamental backdrop right now that we think suggests we're earlier in a multi-year, maybe multi-decade, kind of trend higher in precious metal prices. And that's precisely because we think fiat currencies are likely going to be, continuing to erode their purchasing power as governments the world over, kick the can on fiscal austerity and print money just to paper over the, problems that they don't want to solve today. So good question.
Thank you. Let's transition over to crypto. So question here related on what are our thoughts on Bitcoin at this stage?
I guess I'll continue to run here, and please understand that what I share here today, or any of us say, it's the reflection of how we as a firm think. Myself, Mike Preston, who's on vacation, Jay, Justin, and Michelle, who's not with us today. We form our 5-person investment committee. So all these things that we're talking about are things that we talk about in great depth in our investment committee. They come out in how we invest our clients' assets and the views we take. I'll start by saying we don't currently own Bitcoin for clients as an investment in our portfolio. We owned it for a very brief time through an ETF. I think it was even before last year. It was 2024, I think. And we had a good reason. It was a 1% position that we owned at the time. Bitcoin, to answer Bitcoin, we have to ask ourselves what is it meant to solve, right? So the genesis for Bitcoin was meant to essentially solve the same problem that we believe precious metals, especially gold, solves, and that's a form of store of value, a form of money that can't be debased by the printing actions of the governments who issue that currency. Okay. And, whereas gold is physically limited, there's only so much in the world and in the universe for that matter, and it's hard to find, so you can't just print it out of thin air. Bitcoin, and I'm going to talk about Bitcoin as the main cryptocurrency. There are all other kind of cryptocurrencies out there that are more sideshows than Bitcoin in many respects. But there's a reason why folks have referred to it as digital gold. It's because from an algorithmic standpoint, a computer coding standpoint, there is a fixed limit to the supply of that particular coin. Now, of course, other people can invent other coins and there could be theoretically an unlimited number of coins. But the key is which, if any, are going to be adopted at scale or viewed at scale by folks as the store of value. And Bitcoin has by far that lead in that department of any other cryptocurrency. So it's holding that title right now. But here's the thing. So the other purpose is the early kind of genesis of Bitcoin. It was also thought that it would be an efficient means to transact and transact commerce instantly and very securely without an intermediary, without a bank or other intermediary in the middle. That has proven to fall far short of initial kind of vision, and there's good reasons for that. It's clunky. It's not the system hasn't adopted yet. So even purists have more or less kind of, I think, moved on from that idea as what a key core purpose of Bitcoin. But there still is a very strong following of folks that think that Bitcoin is destined to continue to be a thing. Now, from purely a price standpoint action, Bitcoin has been very volatile. And in fact, in the recent weeks and months that precious metals have been very strong, Bitcoin has actually been quite weak. Let me share a chart of that for folks here. I'm going to share a chart of an ETF that follows Bitcoin. So let me do this here. This is a chart of, again, a Bitcoin ETF, and I'll pull that up. All the same while what we saw, so this is a daily chart. I'll go weekly just to give it a little more perspective. During this period of 2025 where we saw gold and silver go way higher, Bitcoin has weakened, and that weakness has even accelerated into this year. We're near lows that we haven't seen since late 2024 on Bitcoin. So it's been very volatile at a time when other, hard currencies like precious metals have actually been very strong. So one of the criticisms that we have, and this goes broadly for investing in general, we don't want to fall in love with any asset. As much as we've been bullish precious metals, we allow ourselves to someday say, that has run its course, or it's not the be all and everything. And that's why we don't have we have a 12.5% target allocation for our clients in the money that we manage for precious metals. As bullish as we are, you might ask, why aren't we 50%? Why aren't we 80%? And it's because there are other things than that one thing. One of my criticisms and our criticisms of Bitcoin is pure maximalists, generally speaking, see it as the only asset. And there's a kind of I want to say a cult-like aspect to it that I think has contributed to some of the price volatility that a truly reliable store of value, hard currency should not be seeing. So we won't rule it out as something that's going to be around for a long time and probably gain further adoption, but it hasn't checked a lot of boxes that we would want to see for our clients, certainly in the near term, for what it's meant to do, like we have turned to precious metals. I don't know if anybody has anything to add there, but it's we could spend 5 hours talking about the theory of Bitcoin and what role it should or should not have.
One thing I'll add, and actually Jay was on this call yesterday with me with a client. They had a question about their exposure to Bitcoin. It wasn't a cold wallet, so it wasn't really ETF form. Small position, roughly 2% of their investable net worth. And I think our candid advice and thoughts were, they didn't need the liquidity now. They still had 50% gains in the position. They're in a high tax bracket, so it didn't make sense to kind of sell it. We thought, keeping it's probably best because of their views on just owning it. But owning it in that type of a closed wallet situation, we feel is much more usable. Just like we talk to our clients about owning physical metals, locally vaulted and such. That kind of same vein of having that quote unquote real asset. So our advice for that call was to hold and not buy more or sell this juncture. Next question, John, on inflation. Is it a good time to buy commodities in the energy sector, even though some expect a recession, or should we wait for major discounts during a capital rotation event?
So we do think we are in the early stages of probably a multi-year strength in commodities across the board, whether you're talking energy, base metals. We've already talked about our views on precious metals. And a lot of the reason for that is kind of the trend lower in the U.S. dollar, which we, notwithstanding today's news about headline news about this potential deal with Russia, the trend has been decidedly lower. And there's you go back to the Mar-a-Lago Accord, and there's good reasons why one should expect the U.S. dollar to continue lower. If for no other reason, for example, the competitiveness of our exports are enhanced the lower the dollar goes. Now, of course, there's a point where the dollar going too low is a problem, but all else being equal, the declining value of the dollar, the policies, both fiscal and monetarily otherwise, we think presents a very strong fundamental backdrop for tangible real assets, commodities being the most basic of those, never mind kind of the economic picture. Now, we have no doubt that we will see a recession at some point. I don't think there's nothing that we see in the data right now that suggests that's imminent. Some of the data points that lead to that are classically lagging indicators. So during a recession, yeah, we might expect commodities to sell off, but I wouldn't make a foregone conclusion that a recession is imminent or even likely in the near term. That will come at some point, and typically with that, you'll see an economic contraction that will, kind of affect the supply-demand equation for basic materials. But it's a bigger picture than just a multi-month recession. I'm just going to pull up a chart that on commodities that I think paints a picture that I think says a lot. So just let me find it in my chart pack here. All right, so here we go. One of the big thing about commodities in general is that there's been a lack of investment in new productive resources across many different categories of commodities. Here's a chart, for example, that shows the capital investment for different commodity producing sectors. And you can see back in 2011, 2012, these were way higher than where we are now. In fact, the trend has been down and projected to be down. So you have this massive mismatch of supply and demand. And on the right side, it's just a graphic showing, over time, going back to 1900, not only were there more easy to find lucrative copper mines, the size of the circle here is meant to be the reserve amount in that particular mine. You can see that the size of the circles have gotten systematically smaller, but the depth of the mines has gotten much, much deeper. So in other words, it's getting harder and harder to mine for all kinds of materials at a time where, actually the global economy is demanding more and more of these. Not only the economy, but this idea of resource hoarding or stockpiling by countries. It's been in the headline news. We have acknowledged that we have a unhealthy reliance on other countries for critical materials that go into pretty much everything that runs our world today. So if every country is viewing that same thing, they're going to start to demand and build stockpiles. So you have this massive supply-demand imbalance that we think will continue, recession aside, over the years to come, to provide a very strong fundamental backdrop for the commodity picture.
Thanks, John. This same question kind of continues here. Please discuss merging dividend income with the projected growth in commodity sector and what investments could be potentially decent for the next 5 to 10 years in commodities.
So broadly, we like the whole commodity space. In fact, right now we have investments in precious metals, miners, and silver bullion. We have investments in industrial metal mining companies, on the global stage. We have holdings in broad-based commodities, including energy commodities, agricultural commodities, softs like coffee and things like that. So we're broadly, and we would recommend such a thing for, obviously this is not personalized advice for any one investor. We'd be happy to have a conversation about your situation, but we think a non-trivial allocation to commodities makes a whole lot of sense for most people right now, given the backdrop. It's not to say that prices won't be volatile. They can be. And in fact, the volatility in there oftentimes is an offset in the opposite helpful direction to volatility in other things like stocks and bonds. So we never advocate 100% of everything. We would never say to someone, put 100% of your financial assets in commodities. So absolutely, alongside commodities can be dividend producing investments, whether they're blue chip stocks or other income vehicles, bonds. All these things can and should be harmonious together in the appropriate dosages and degrees at any given point in time. So it's not an either or, it's an and is the broad way I would look at that. So and obviously for the person who asked that question, happy to have a personalized conversation relates to your situation.
All right, John, I'm going to fire them all at you, I guess. This next one's getting into bond interest rates and such. I'm not going to read the whole question because it's pretty detailed, but in general, with short-term rates falling recently and probably projected over the next 6 months to a year, lower short-term rates, what are our thoughts on someone's portfolio staying on the higher rate, the longer-term U.S. Treasuries, for yield now? And of course, if the feeling this person has too is if the market crashes, that the yield or the value of their long-term bonds should soar, and they'd sell those to buy the market after. Maybe share your thoughts on that kind of a strategy someone might have.
Yeah, sure. So a couple quick concepts: short-term and long-term interest rates. The Federal Reserve has direct control over short-term interest rates by how they set the federal funds target rate. And I'll share a picture of that so we can see what that looks like. Here's what's called the CME Fed futures. This right now, the current federal fund target rate is 3.5 to 3.75%. That's right here. Okay, you need to put a decimal place in there. And right here are the dates of upcoming Federal Reserve meetings. So these are the dates where the Fed announces, are we going to keep rates the same? We're going to drop them. We're going to increase them. What you see here is the blue boxes represent the most probable scenario for that given time based upon what the market expects. So the market isn't expecting another rate cut until June. They think the market thinks there's a 50% chance we'll be at 25.25% lower than we are right now. And then the next one is in September. So, and none further from there until way out December of 2027. So call it 2 quarter-point rate cuts priced in or as the base expectation by the market. So that'll bring us from 3.5 to 3.75 to 3 to 3.25. Still quite a bit higher than 0 where we were in the years after the housing bust. So the question is, what about long-term rates? Now, long-term rates are driven by more things like worries about fiscal health, worries about economic activity, worries about capital flight from the U.S. And this here is a chart of the 10-year Treasury yield. So this is 10-year Treasury bonds. What you can see here is we've had and I'm going to zoom out even further. We've had a broad range here. So we had a big spike in Treasury bond yields from 2020 up through 2022. And that's when the inflation went through the roof. And bond investors learned really quick that bonds can be a very risky investment if they're priced inappropriately, as bonds were back here. Since then, we've had this very, somewhat tight range. In fact, I can draw a tighter range. Basically, 10-year Treasury yields have gone between, let's call it 3.6 and 5 since about, what was that, early 2023. And we've been just kind of going around pretty much nowhere here. The big question is, should I be going out further on the yield curve? Well, the question there depends on what happens. There's plausible scenarios where rates could drop or go higher. So, for example, traditionally in a recession, you would see rates tend to drop. That's not a guarantee. The recessions in the 70s actually saw rates go higher, okay, because there was inflation and there was stagflation. There has been, again, this idea of capital flight, notwithstanding the news from on the Russia front today, there has been, plausible scenarios about capital flight. For example, Japanese government bond yields have shot much higher. Suddenly, it looks much more attractive for domestic Japanese citizens and even institutions to start buying their own bonds rather than U.S. bonds on a relative basis. So there is this idea that we could have rates go even higher. That's why how we're positioned right now, we are very much leaning towards the short end of the curve. In our tactical model, we have about 20% allocated to very short-term Treasury bills. It's called 6 months or less, generally speaking. We have another 5% in 3 to 7 year Treasuries, and only about 7.5% in longer-term Treasuries. If we were more convicted about longer-term rates not trending higher, we would have a more significant position there. But it's enough of a scenario where we're perfectly content having a modest position, not zero. There's good reason to have non-zero too. Today alone, we're seeing long-term Treasury rates drop off quite a bit. You can see there's been recent decline here, and as a result, long-term bonds are actually rallying quite hard today. Whereas not much else is. The only very much, among the few things rallying today on this Russian news are long-term Treasuries. So there's a good reason to have a piece, not a huge piece, but doesn't mean you have to have zero either. So I'm going to take a quick glance at that question, make sure I touched upon all the important points there. But help me, Justin, and Jay or any other team.
Yeah, I'll jump in. And JB, you want to chat about the longer-term Treasury 20-year duration, but that position's up about a little over 1% today and about 2.5% year to date. The S&P is actually, I think, down a little on the year now as of today's move. But yeah, the duration risk and holding longer-term Treasuries for a trade, not for an allocation or a long period of time, is helpful in times like this with uncertainty, or when our bullish indicators and bearish indicators are right in the fence, of not wanting us to go short / hedge using options. I shouldn't say short, I meant to be buying puts, or to go much more materially long in the market.
I think you guys covered most of it. Can you repeat the question for me, though? I don't want to.
Just the longer term duration, 20-year duration Treasuries, and why we hold a little slice as a trade.
Well, yeah, we hold them as a trade because exactly like you said, for the duration, right? If interest rates move a lot, which we would expect in an environment that's conducive to risk off or a deflationary environment, then by going further out the curve, you introduce more price fluctuation. That's why we hold these, is so that if we get that kind of risk off moment, or when we get that risk off moment, these should do pretty well. And we've long stated that we feel that this is something that we're going to have to contend with at some point. And besides that, in the interim, they're earning a very strong yield. That's why we hold them. And in terms of why we would do them at a portfolio level in an ETF, it's just a lot more simple than going out and buying fixed coupon specific issues, as what I would say. So that's kind of my
right.
2
Jay, we
cents.
could use options on that position as well if we
Exactly.
felt we needed to do that to navigate it. And
Justin, I want to add one more quick
Yep.
thing, and perhaps Regina could put in the chat here. I did a video on bonds in general, and it gets into some of the plumbing of how bonds work. So some folks might be interested in that. But the original question asked about a specific ETF, and I want to share that because it will allow me to kind of talk about this concept called duration. It's a simple concept, but it's one that I think is important for folks to understand. So here is an ETF called VGLT, the Vanguard Long-Term Treasury ETF. Okay, not a recommendation. I'm just using this as an instructive point. So you'll see here there are 96 bonds in that particular ETF. The yield to maturity is 4.8%. The average coupon is 3.4. And you see this, the effective maturity is about 22 years, but then you see this thing, average duration, 13.9 years. The duration is a measure of how sensitive this portfolio of bonds would be to a percentage move in interest rates. And it's not quite as simple as a linear relationship due to this thing called bond convexity. And that's a whole complicated thing that we can't get into right now. But the simple way to think about this is for each 1% move higher in interest rates for this kind of tenor of bond, you would expect this particular portfolio to lose about 14%. Okay, so as interest rates go up, bond values go down. That's like a law of the universe, generally speaking. Mortgage bonds are a totally different thing. But so take this 14-year duration, 13.9. So 1% move higher in interest rates, you could expect that this portfolio would lose about 14%. Okay. Now, if you're getting an effective yield here of where's the SEC yield here? SEC yield is 4.84%. So if we saw a move like that in interest rates, I'm not predicting it, but if we did, and you suddenly lost 14% of your value in this holding, it would take like 3 years of coupons to make up for that. You know, that's where duration is helpful to understanding how sensitive a particular bond portfolio might be to a move in interest rates. It works the other way, of course. If interest rates dropped by 1%, you'd expect this thing to go up roughly about 14%. So it really very much depends on your view and the direction of that view and how big that move might be as to whether it makes sense to go out further on the maturity spectrum rather than keeping things very short. Again, I'll reemphasize, we're keeping things decidedly short for a lot of reasons, but there will be a time where that maybe will change.
Thank you. On the line of treasuries, some questions here on safety of owning treasuries in general. What are your thoughts on that?
My quick comment here is just because treasuries might not be as conducive to having a 40% allocation like the traditional 60-40 might, doesn't mean they're going to zero either. One of the big mistakes I think many investors can make is that they, just because something isn't perfect, they throw it out altogether. So obviously we've been very strong proponents of precious metals, because one small part of which is because of the debasement of the US dollar. Now, that doesn't mean we think the dollar is going to zero, nor does it mean that folks shouldn't have a good chunk of their money in US dollars for US investors. Same with treasuries. Are they safe? Yes, they're safe. Can they lose value? Yes, they can. Are they susceptible to higher interest rates potentially if there's a capital flight or return of inflation? Yes, there is, but that's investment volatility, is not a black and white safety. So I do think treasuries remain, from the standpoint of financial assets, one of the safest in terms of counterparty risk investments. It doesn't mean they're the safest investment from a return standpoint. And that can be answered by just being shorter term versus longer term if you're worried about interest rates going higher. But as you know, is the U.S. government going to go bankrupt and they're going to default on paying back your treasuries? Very low probability of that, and a whole lot of else would have to go wrong in the world for that to be a problem. Because the U.S. government ultimately can just print their way out of indebtedness, and that's essentially what every country, every government does in the late stages of a sometimes 100+ year cycle of things.
John, our thoughts on the balance between taking profits that we've advocated along the way with the recent run up in metals and potentially pushing one into a higher tax bracket, including IRMA implications. What are our thoughts on those?
So it's always a personalized conversation. A couple things. When you have assets in a non-retirement account and they're appreciated, the only way for someone not to have tax liability on those assets someday is for one to die with those assets and get a step up in cost basis so that one's heirs can get that step up in basis. Under the current tax code, if you own something that's up 500%, a stock or a capital asset, and you die, your heirs get that asset with a stepped up basis at that time of death. So they can then sell it without any capital gains. But again, you have to die for that, right? And so it's circumstantial. Someone that is later on in life, perhaps very sick or whatever, that's a valid thing to think about. Folks where that's not such a valid thing, it becomes a question of the allocation of your overall portfolio. I would urge you not to think about an investment in isolation, but your overall portfolio. If you have too much of something in your portfolio, absolutely scale back, book some gains, pay the taxes on the gain. Worse sin than that is to have the magnitude of those gains get diminished or erased altogether. Yeah, you won't owe taxes, but you also have shot yourself in the foot in terms of the total outcome. Bottom line is, if you're paying long-term capital gains rates at 15 or even 20%, even if you have to pay the extra investment income tax of I think it's 3.9%, that's a heck of a lot better than losing 100% of your gains, right? So it's all circumstantial. You want to be very thoughtful as to how this fits into your life. Ultimately, most people we work with want this money to be used during their lifetime, whether it's for their living expenses or experiences through travel or charitable gifting, which is a way you can avoid gains by gifting. But the IRMA thing, I'm just going to share my screen on the IRMA. IRMA is kind of a little bit of a pesky thing that, one of the many little, pesky things about our tax code that comes back to surprise people because they're not aware of it. IRMA stands for income-related annual adjustment. I forget the actual name of it, but IRMA is the abbreviation. And this can affect if you have a high reported income (AGI) in a given year, it can affect your Medicare and Medicaid, and prescription drug premiums. So let's just look at this: married filing jointly, for example. If you have over $218,000 of reported income, that could be employment income, taxable Social Security benefits, pension, as well as capital gains. So capital gains factor into this. Okay, if you get above 218, between 218 and 274, your monthly Part B Medicare adjustment is going to be $81 additional, and your Part D prescription drug is another $14. So call it $100 additional monthly. Call it another $1,200 annual cost. Now, importantly, the basis for these determinations is 2 years prior. So for 2026, it's going to be based upon your 2024 reported income. So it's always 2 years look back, right? Now, even if you book a tremendous amount of income, you're above 750, for example, we're talking about, let's call it $600 a month, just to be generous. That times 12 is what? $7,200. It's not the end of the world if you have $7,200 of extra expense for Medicare, if by so doing you were able to keep gains that otherwise would have been lost, hundreds of thousands of dollars of gains that might have been lost if you didn't sell off a highly appreciated asset before it sold off. Again, it's all highly circumstantial to what investment we're talking about, how it fits into your particular portfolio. But this is a kind of thing that hurts because it's surprising to a lot of people, even if the actual financial impact is rather inconsequential in the grand scheme of things. Sometimes it hurts because it's a surprise to a lot of people. So just something to be aware of, and good question to ask.
Thanks, John. Yeah, lots of moving parts there. Everyone's individual situation is different. And of course, that's why many of our clients have us connect with their CPAs as well along the way. Next question regarding precious metals again. Per New Harbor's recommendations, we purchased a quantity of gold and silver back in 2020, and now that represents about 20% of our portfolio. We have also inherited a significant amount of sterling silver, I'm guessing in terms of maybe jewelry, but also cutlery and such. Given that our uptick in precious metals price in silver, what are your thoughts on melting the sterling silver and investing in proceeds?
Well, that's about as personal a question as can get. Whoever asked the question there, and I see it is a client. We'd love to have a personal conversation with you about that. But well, the first thing I would ask, how important is that silverware or silver jewelry to you? Perhaps it's a family heirloom that has some special sentimental meaning to you. That would certainly, I would hope, would weigh into your decision. It's very easy to sell coinage or more fungible precious metals without having to go through a melting or a forgery forge process to convert it into something to sell. Can it be done? Sure. If you have a pile of silver jewelry or silverware that means nothing to you from a sentimental standpoint, and you don't wear it, you don't like it, sure, that absolutely. In fact, one of the things I will remind, back in 2011, when precious metals were reaching their heights, we were concerned that there was a bubble going on, because there were like literally at home cash, for gold parties, where kind of like, Tupperware parties or Avon parties, folks would get together, bring their gold, and the host would take that gold, give them money for it, and go and sell it on the wholesale market. That, to us, we haven't seen any of that stuff going on recently. So there's another market difference. But the point is, yes, it can be done. If it means something to you, I would think about selling some of your more fungible forms of precious metals, all for the purpose of, if it's become too much of a part of your total picture relative to where you're comfortable and relative to how it fits in your life, and how, your ability to kind of use your money to live. And, you can't live on money, precious metals sitting in a vault somewhere. Hopefully that can be converted into spendable dollars when you need it. Absolutely, that's something that should be considered, and be happy to have a personal conversation with you about that.
All right, Jay, let's get you on here. Precious metals. Could you please discuss New Harbor's allocation and strategy for precious metals for 2026? Also, do we feel it's a good long-term hold for the next 5 years or so, precious metals in general? And if the stock market isn't going to return much over the next decade, why would an investor diversify out of precious metals, especially from gold?
Yeah, so this conjures up, it's very similar to what John was talking about, but it conjures up a abbreviation that we've been hearing a lot from people, called TINA. There is no alternative. There is, unfortunately, always an alternative. While we are very bullish on precious metals and have been, just like John said, and we're going to sound like a broken record here, and just like, that email we sent out to our clients a week ago said, it's all about position sizing. It's all about what you need to be comfortable in your living situation. There are people that are comfortable and feel the need to have, 50% precious metals out there, and that's okay. That's exactly, if that's something that they're okay with and they can handle the volatility, that's their decision. The way we see it, we do feel that a 5 to 10% allocation in physical, makes sense for people to kind of have and just forget about, never look back. At the same time, with this volatility that we've recently experienced in the market, people are feeling trapped. They're like, oh, I should have sold. Why didn't I sell before? Maybe I should wait. It has had a fantastic run in the past year, even when Mike and I were looking at the price after the huge pullback on that Friday. That was right back to where it was on Christmas Eve, right? So people should not feel like they can't let go or they can't trim if it's making them uncomfortable. But at the same time, that level is different for everybody, right? So to get to the nuts and bolts of the question, our strategy and allocation for precious metals for 2026, I would argue, is just about the same as it was a month ago, right? We're watching the market signals. We're adjusting our allocation as the market dictates. We're taking hedges where appropriate. If we see the precious metals market roll over materially, and we feel that's a risk to clients, then we'll take action and make sure that they're not overexposed. How's that look over the long term, over the next 5 years? Dollar debasement trade is very much still in play. We're still seeing the dollar weak today, even with that big headline with Russia and Trump and by extension us. We do think that's a structural change, and that precious metal that's conducive to strong precious metals prices. So I would say what we've been saying for the past 2 months, 3 months, a year, 2 years, I think it's the same messaging there. I hope that's straightforward enough. I'm not sure if John or Justin, you have anything to add to that, but.
No, thank you, Jay.
Thank you, Jay. Just 4 or so minutes left. We try to keep this succinct to 3 p.m. I'm going to jump to a question here. The market has been extremely overvalued for several years, and I've been keeping a huge cash position anticipating a correction. Meanwhile, I've missed out on tremendous gains. Is the correction ever going to come, or is the market just reflecting the Fed's ongoing printing and resultant inflation?
So we have no doubt there will be corrections to come. Probably a whole bunch of the garden variety ones of 10, 20, 30%. And there's a high probability, not a certainty, but a very high probability of one that is much larger. If you go back in history and look at the valuations that we have right now in the U.S., the only way these have ever been resolved is by major market sell-offs. Already this century, the tech bubble and the housing bust brought the S&P 500, for example, down over 50% peak to trough. The valuations we're at right now are every bit permissive of such a decline, but it won't happen like out of thin air. There will be catalysts. There'll be economic slowdowns. There'll be systemic, risks that come shooting over the bow. So it's important to be mindful of valuations, and we continue to learn this lesson. I mean, if we could go back in time, there have been times where we've been every bit more conservative than perhaps we should have been based upon valuations alone. That's why our process, our discipline is meant to be very cognizant of where we are in valuations. That's why we're underweight equities in no small part relative to most traditional advisors, because the valuation climate is hyper extreme here in the US. But there are times where markets are going to do irrational things. They're going to do things that aren't supposed to happen, including go up when they're not supposed to. And that's why we combine a tactical discipline with additional tools like the hedging that can allow us to be wrong, hopefully with not big consequence. So my advice to the question asker there is that just try not to be paralyzed. Know that it's not an irrevocable decision to get more invested, nor is it, and it doesn't keep you from getting uninvested. And I would just think about it in terms of, systematic dollar cost averaging, toe dipping. Sometimes doing something is a little bit more, alleviating from a psychological standpoint of, sitting out. Again, we're about 47.5% in equities in our core model, but even that, we have some clients that want to be less exposed because of their concerns and their preference or prioritization on downside protection versus upside gain. So we have, for example, some of our clients want to be 25% in the equity, a quarter of the equity exposure that our tactical model would otherwise suggest. And that's perfectly fine. It's right for them. And we'd be happy to talk with anybody, client or folks just listening in here, how we can tilt our model in a way that speaks to them and their situation and what their concerns are. Right now, our near-term prognosis is that markets will probably, trudge higher here. There's not nothing in our dashboard that would suggest an imminent collapse or decline. That could change pretty quickly, and we'll adapt as we see accordingly. But it can be very tricky. We understand the nature of the question. We'd be happy to talk about your situation and help you through that dilemma as to timing.
Thanks, John. Jay, we have time for this last one if you want it on the U.S. dollar. Do you wish to answer that question if the U.S. dollar can survive?
I'll take a stab at it. I'll let you or John tag in. can the US dollar survive? At this rate, I could see why you would think no. But, the big thing with this that we have to remember is that there have been numerous reserve currencies in history. One of the most prolific, or one that's still around, is the pound, right? The pound, while it is no longer the reserve currency, and there's a litany of things you could say about the British economy and how it is, or how it's doing, or how poor it's doing, the pound is still around. So, while the reserve currency status is certainly to be questioned, and we're making very quick moves towards that being a sticking point in the near future, I would say that the US dollar can survive, but you're going to want to take steps to prepare for further debasement potentially. So that's my quick.
Yeah, I would just say more emphatically, and I'm sure Jay agrees with this. Yes, it will. Not only can it survive, it will survive. It won't go to zero. And as much as we think precious metals are important, for example, it's an and, it's not an or. Being bullish precious metals doesn't mean you have to believe that the US dollar is going to zero. Both of them have a proper role in most folks' portfolios.
All right, everyone, it's just past 3 p.m. Eastern. Thank you for joining today. Regina, thanks for setting this all up for us. We look forward to having a full team next time, including Mike and Michelle, for our next live Q&A. Don't feel, this takes place of a call with us. So we look forward to chatting with our clients soon. And thanks for joining today.
Thank you, everybody.
Have a good one, guys.